All right, so let's go ahead and get started. We're gonna have George presenting today. He's the Strategic Alliance Manager with Avalara, and he's gonna go ahead and talk about the impact of sales tax with the new Supreme Court rulings. George, I'm gonna go ahead and give you the mouse and control so you can click through the slide deck.
Perfect. Can you hear me okay?
There's a little bit of an echo.
Okay. Can you hear me now? Is that better?
Yeah, that sounds better.
Okay, perfect. All right, well, thank you, everyone. I appreciate your time today. What I'm going to be talking about today is economic nexus and the future of sales tax. Basically, the Supreme Court ruling really impacted a lot of businesses in the United States, and it's had a dramatic effect, both on people who collect sales tax and also companies that do not collect sales tax. So let me just go over here. Did you have any control?
Yeah, you should have control.
Okay, here we go. So what I'll do is talk about South Dakota versus the Wayfair ruling, economic nexus, and how it affects you, even if you're not collecting sales tax. What should you do? Automating sales tax compliance, and any questions and answers you may have at the very end. So what was South Dakota versus Wayfair? Well, to talk about South Dakota versus Wayfair, first you have to talk about North Dakota versus the Quill Corp. In 1992, the Quill Corp was sued by the state of North Dakota, and they were told that they have to collect sales tax to their residents. The Quill Corp went to court and said, we don't have a physical presence in the state, so we're not required to collect sales tax. Well, it went to the Supreme Court, and the Supreme Court decided that no, they didn't have to collect sales tax. However, they left open the idea of from state to state as what entailed physical presence. So fast forward to 2018, the Supreme Court again heard another case that was the exact same case from Quill Corp versus North Dakota, and that was Wayfair versus South Dakota. Now, why the Dakotas, you may ask? Well, because there's not many people in those states, and they need to collect as much revenue as possible. So these are the ones that were really dying to get revenue. So the Wayfair versus South Dakota was literally the exact same case and the exact same argument. However, this time, the Supreme Court sided in favor of South Dakota. And the reason why they sided with the state and said that they do have physical presence is because of the internet. The internet has literally changed the landscape of commerce as we know it. You no longer need a physical location to actually sell to residents of any state. So because of that, states were noticing that there was hundreds of millions of dollars that were being lost in potential revenue. So it did overturn the long-standing physical presence rule, determining whether a state can collect sales tax. So it had granted authority to impose sales tax obligations on out-of-state transactions. Okay, so who's affected? Remote sellers right now who are currently registered within the state and threshold requirements. So instead of having a physical presence requirement, now you have annual sales in excess of $100,000 or 200 transactions into the state of South Dakota. Now, what you'll notice is that I'm actually quoting exactly what the rules are for the state of South Dakota. The reason why is because every single state is different in their requirements. So the most impactful rule is that the physical presence rule has been overturned. So what it does is it adds an economic nexus to the existing list of nexus creating activities. So the South Dakota rule applies to taxable sales it made to consumers, but it doesn't change what is tax exempt. And this is one big thing that is possibly the most impactful from the South Dakota versus Wayfair ruling. It'll apply to service providers and not just tangible personal property, as South Dakota taxes many services. Now, the thing is that other states do the same thing. So services are now being taxed, and if you reach a certain threshold within a certain state, you could be held liable to either collect sales tax or file exemptions or collect exemption certificates as to why you didn't collect sales tax. And it also applies to manufacturers and wholesalers who sell directly to consumers. Okay, so economic nexus and why is it important? The reason why it's important is because 47% of revenue right now is from state, is by sales tax. So 47% is made up of state revenue. And the reason why it's such a big number is because no one's ever gotten elected by saying, hey, we're going to raise your property taxes, or hey, we're going to raise your income taxes. The way that states can charge the most taxes without getting, quote unquote, too much blood on their hands is by actually collecting sales tax. So economic nexus is just a tax collection obligation imposed on sellers based on economic level or activity within a state. So unlike physical presence, it's based entirely on sales revenue, transactions, volume, or both. But like most sales tax laws, it varies by state to state. Now, this also adds to what is already existed for what nexus is. And nexus, if you don't know, simply means the obligation to collect sales tax within a certain area. So 1 month after the Supreme Court ruling, what you'll notice is right here of all the states that adopted this economic nexus. So you'll notice that 19 states automatically had that shift to where they had to collect sales tax. However, 3 months later, you'll look at October 4th, you look at all these states. Now you're looking at 29 states that are actually adopted this economic nexus level. So in January 2019, you're looking at 34 states that actually have adopted economic nexus. And you'll just notice how wide of a range this is growing. It's not a question of if it's going to reach your state, it's a question of when. And it's not necessarily even reaching your state. It's a question of what business you're doing sales in. So, for example, if you're in Florida, it doesn't matter whether you're not part of that. All the other states around you are now being collected. Now, if you look here, you're looking at 38 states. Now, here's the most important aspect. If you're not collecting sales tax right now, if you're not required to collect sales tax, if you look at the orange states, whether it's Maine, Illinois, Washington, Wisconsin, Colorado, Washington, D.C., Wyoming, and there are new states as well that have adopted this law, what you're looking at is that there's 18 states that are in orange. And I don't have the entire list right here. But what they do is that even if you are not collecting sales tax, you are required to collect exemption certificates if you reach the economic level, regardless of whether it's exempt or not. So, for example, if you're selling into Illinois, regardless of whether or not you have physical presence, and regardless of whether or not you have to collect sales tax, once you hit $100,000 in exempt sales in the state of Illinois, you still have to file exemption certificates. You still have to collect exemption certificates and file a $0 return into that state. So one thing that you're looking at is, for example, a manufacturer in New York. Before, there were 99% of sales were no tax. Well, the Wayfair ruling increased their burden of proof because of the exempt sales. So before, they had to manage less than 75 exemption certificates, but now they're required to collect over 1,000 exemption certificates as a result. Then you have a national wholesaler. They sell to end-to-end users, and it's drop shipment as part of their model. Well, because of the Wayfair decision, it grew their nexus from just their headquarters in New York to most states. So instead of having to manage only 500 exemption certificates, now they have to manage over 5,000 exemption certificates. And doing this manually can be really a challenge. And is it necessarily the best use of your time? Probably not. So what can you do? So first, call your SALT CPA. And a SALT CPA is simply a state and local tax CPA. The reason why you want a specialist that handles state and local taxes is because CPAs are kind of like attorneys or doctors. You're not going to go get heart surgery from someone who's an orthopedist and specializes in knees. There was over 14,000 sales tax changes last year alone. So imagine being a CPA in Atlanta, Georgia, and trying to figure out what these sales tax laws are in multiple states. It's kind of a challenge, and I'm going to show you in a little bit what that exactly entails and why it doesn't necessarily make sense. So automating sales tax compliance. Sorry, I'm having a little bit of trouble shifting here. But once it's populated, it'll tell you about the crazy tax laws that are within a state. So looking, for example, and this shows the utter ludicrousy of sales tax law in the United States. So if you take a candy bar in the state of Indiana, well, a candy bar, it's, candy, so it's taxable. However, if you buy a cookies and cream Hershey bar, it's tax-free. Or a Kit Kat, it's also tax-free. Or Twix is also tax-free. You know why? Because there's wheat flour in that candy. And because there's wheat flour in those three items, whether it's a Kit Kat, Twix, or a cookies and cream Hershey bar, because there's wheat flour, now it's tax-free. Because wheat is a subsidized item in the state of Indiana. Take donuts, for example. If you buy 5 donuts or less in the state of Texas, taxable. However, if you buy 6 donuts or more, it is tax-free. Buying a bagel in New York. Well, if you buy a bagel, it's considered a food, so it's tax-free. However, if you slice that bagel in half, all of a sudden, there's a tax associated to it. Why do you ask? Because it's prepared food. And since you just sliced it, now you have to pay that sales tax. And it's not just limited to products either. Look at services. So, for example, snow removal in the Midwest. Well, it's taxable in Ohio, but it's exempt in Illinois. Or tree trimming in California. With just the light, that's taxable. But the labor is exempt. So here's the jurisdiction assignment. And saying, let's say you're going to decide to figure out these sales tax rates on your own. Well, take, for example, Denver. Now, if we zoom in, need to go with, you'll see Greenwood Village, which is 80111. Now, Greenwood Village, you would think that has only one set of tax rates. Well, that's incorrect. Because of redistricting, or gerrymandering, depending on which side of the political fence you fall on, you would have missed all 3 different cities, 2 different counties, because sales tax rates are calculated based on congressional districts. Regardless of whether it's a zip plus 4, this congressional district, the orange one, is stuck in the middle of the green. And so a zip plus 4 wouldn't have been accurate. At the end of the day, calculating based on sales tax zip code rates are they're just inaccurate. So what we do is we do a GPS coordinates where we'll actually track exactly where your property is and base it off a GPS coordinate model. So let's say you say, okay, I'm going to calculate the rates on my own, but now I'm going to do the sales tax returns myself. Well, here's 15 pages of California state tax returns that has taken our most senior engineer 2 hours to do. Now I'm just going to go page by page as to what that entails. So there's page 1, page 2, page 3. Now what you'll notice as I'm going is that all of these cities are broken down. So you have to calculate the rates for every single city in that county. And you have to line itemize everything. And every city has different rates. Now, is this the best use of your time trying to figure this out? It really isn't. So Avalara is an end-to-end solution that manages your AvaTax calculations. It also manages your exemption certificate, and it also calculates your returns. So our company literally is an end-to-end solution, and we handle over 18 million exemption certificates. We do 6.7 billion transactions, and we remit and file $28.9 billion in taxes. So one thing that we do with exemption certificates is we also segment the exemption certificates. So we categorize them, whether it's by state or by type. So whether it's manufacturing exemption certificates, governmental exemption certificates, religious organizations, agriculture, resale, or even charity. And then we can also manage other things other than those exemption certificates within our system, whether it's W-9s or TIN verifications as well. So Avalara is one of the only companies that we're a software company that does taxes, not a tax company that does software. And the distinction is that we do a seamless integration to where we will go on your ERP system, whether you're doing a ERP, a COS system, or a CRM, however you need to do it. We have over 600 integrations. We have currently all of the Microsoft connectors as well, and it's very seamless. And we're born and raised in the cloud. So one of the things that we have is that we are one of the only providers in the country that offer streamlined sales tax. Now, streamlined sales tax is a service that's subsidized by the state. Right now, it's 24 states that basically reduces the cost and burdens of retail. So in up to 24 states, you can get free registrations, free calculations, free returns of preparation and filing, audit assistance and response, uniform definition and rules, and one registration and identification number for all of them. Also, another thing that's amazing is that when you're in that program, we actually represent you to the states. And the way that you can qualify, and you can sign up for this program no matter what, but it's a question of how much free stuff you can get. So it's perfect for people that are currently in the e-commerce space or someone that doesn't have physical presence, because all of these requirements right now are physical presence requirements. So whether you've had a fixed place of business for less than 30 days, let's say you're in the state of Georgia, except you sell to Alabama, but you currently don't have physical presence. Well, this is all physical presence properties, in which case you would qualify for free registration, calculations, returns. Essentially, it's like getting Avalara for free because it's being subsidized by the government. And here are some of our logos. We have something for everyone. Obviously, I picked the biggest names just because you would recognize them. But we also are economies of scale, so we have something for everyone. But I would dare say that you work with someone that has Avalara in their system, whether you picked up, a glove and a bat at Dick's Sporting Goods, or whether you're using Salesforce right now as your CRM, or whether you're even writing all these notes down on a Post-it note with 3M, or maybe you're wearing Adidas. We are wide range wide-reaching within our ecospace, and we are a required necessity. I mean, the only thing that's certain is death and taxes. So, and that's all I have. I'd love to take any questions that you may have at the time. I apologize for the delay in the slideshow. For some reason, it wasn't clicking as well as I'd hoped. But I hope it was informative, and I'd be happy to take any questions right now. Okay, so a question I have here is, do I have to change any of the current ERP processes to use Avalara? Avalara is a completely seamless solution, so you have to change literally nothing into your system. It'll automatically populate the correct rates and all your processes, whether it's managing your exempt certificates or doing returns as well. We do that automatically for you. Second question is, when taxability rules or tax boundaries change, do I need to do anything to update my tax schedule? The beauty of Avalara is that we are a seamless cloud-based solution that's automated, and it's updated automatically. So anytime there is a change, it is updated in real time. So you don't have to worry about maintaining that. And we're the only company also that guarantees our rates. So we are very proud of that. Any other questions?
I'm not seeing any other questions coming in, but if anybody has any questions that we don't get to or that you think of after, feel free to go ahead and email us at dpv@sisn.com. We'd love to discuss this more in depth with you, and want to thank you, George, for taking the time to present this today and bearing with us through some technical difficulties. You did a great job, and want to wish everybody a happy afternoon, and we're going to send out the recording shortly after. Thanks, everybody.